Oh, so we're starting off here, and I see Green Bay Packers on today's guest sweatshirt. So before we get anywhere, first of all, Sean, welcome to the show. Green Bay, where are you? Where are you coming to it to us here from today?
You know, this is gonna be like it's gonna make it even worse. I actually live in the Chicago suburbs, but
Oh, wow.
I spent a lot of time in Wisconsin growing up. I lived in Wisconsin when I was 5 or 6. Um, so I've been a Packers fan since then.
So there's just
Thanks.
something in me that's still liking the game Sunday, which is yesterday. We're recording this, and the Lions just beat the Packers. Lions are 6-1 prior to this game. Packers were 6-2, I believe, prior to that game, and the Lions got them, huh?
They did. And they played well. Packers didn't, and well deserved win in the Lions column and a big L on the Packers side.
Tell us a little bit about Sean.
Yeah, for sure. So originally from the Chicago area, I live here now. Moved 22 times in the interim before I went off to college, which is what got me interested in real estate. Yeah, it was quite a bit of moving, and I went down, we'll call it like a very traditional business path. So I went to Wharton's undergrad program, finished up working consulting for BCG for a couple of years, and had a thesis from real estate from the beginning due to kind of all that moving so much. So as soon as I started making some capital on my side for my job, started buying some real estate, and then compounded to the point where other folks wanted to join in, and now it's a full-fledged fund. And there's a lot of data that we look at that helps us figure out what that is. As an example, like our favorite data set is we've got one that shows the percent of the high school graduating class that goes to Harvard, MIT, or Stanford. It's the most predictive data set we have about rental premium. There's kind of a magic bump where if you got above a certain percent of the high school graduating class going to those 3 schools, your rent is about 60% higher than the town over. So that
You said
that's
what
something
percent higher?
60.
60%. Interesting.
So that's on the demand side. On the supply side of the equation, we are very intentionally trying to buy in areas where there is not rental supply. We're looking for areas, median home ownership rates in the country is mid 60%. We're looking for areas where the owner occupancy rate is 90%. We're looking for areas that don't have buildable land left. We're looking for areas that have historically blocked multifamily development. And then when you combine those two together on that supply and demand element, like you've got a really good reason to want to be in that area, the really good school district, and you don't have a lot of rentals available at the same time because there just aren't. Most people own their homes there, and there aren't multifamily properties. There's no land to build new rentals, and that's what creates kind of this pricing pressure, which pushes up the rent, and it's why we're able to charge kind of a pretty significant rental premium. The biggest challenge for us is really data and making sure the data is working fast enough for us. Our offer, so right now we're winning 55.1% of offers that we place, which we're happy with. But the reason why we're winning those offers is because we built custom software on top of the MLS. So when a home hits the MLS, it automatically runs through our software. It runs through a bunch of checks. We're bringing in additional data on top of it to help us underwrite each individual house very quickly. So when we put an offer in, it's typically in less than an hour after the home has actually been on the market. Because we want to get the home under contract, we want to get inspected, we want to lock up exclusivity for like a week or so then we can really do the deeper diligence, which is great. The challenge with that is when the data itself takes a lot of time and effort to make sure that it's working correctly, and it constantly changes and constantly breaks. So the biggest thing that we need to do is like maintaining the system is the hardest part of acquisitions for us right now. Fundraising's been kind of an interesting beast, and there's a lot of kind of different elements to what we're doing. When we first got started, it was a lot of meeting people, telling our story, meeting people who are excited about it. And we had an initial group of 45 folks who came in on the fund and got excited about it and joined us. Now that we're kind of up and running and we have data points and people can actually buy into the existing fund, so they're actually buying underlying real estate, things have gotten a lot more interesting. So we're Finishing up audits right now, where we're going to get listed on a couple RIA platforms where registered investment advisors can allocate their clients' money to us. And we're in conversations with some pretty significant real estate groups about some material checks to come join the business. But we are really excited always to meet folks. We've got a lot of people on the investor side who are from really good school districts themselves, or that have moved themselves to a really good school district to support their kids. So we're always excited to meet folks who fit that definition, because they tend to get it and understand why somebody would do this, because they themselves have moved to a good school district.
How do you make money?
So on our side, we're a true fund model. We're registered with the SEC. We've got a lot of different accounting firms. That's actually probably our biggest bottleneck, is like the number of vendors that we have to use. But we've got what's called an 8% preferred return, and then an 80-20 split above that 8. Meaning, if an investor joins the fund with us, they get 100% of everything that the fund makes until they've made 8% on their money. And then for every dollar after 8%, they get 80 cents on the dollar, and we get 20 cents on the dollar. I think the biggest thing is the concept of like unknown unknowns are what can absolutely screw you. And meaning like that's where the business loses money, that's where you lose money, that's where things go wrong. And figuring out like what unknown unknowns are is extremely difficult to do if you don't get to know people who have kind of been through your shoes and can provide advice and kind of help steer you around those roadblocks. So I would tell me 10 years ago to, or my kids if they were 10 years younger, to do everything they possibly can to identify unknown unknowns and try to figure that out. And then I think the secondary thing is I would tell younger me or kids to go values first. So for example, like our number one value at Scholastic is to protect our investors' shares. Like our minimum investment is a high amount. Like it takes the average American years to save that amount of money. And like if we do something silly and lose their money, like it's equivalent to losing years off of someone's life. Like that is just, it's not acceptable. That's not allowed. And being values first makes it really easy to kind of frame decision making and how things work. For example, like we hired somebody 2 weeks ago, and we realized in the first 48 hours like he wasn't aligned with that value, and like we made the decision to move away from him immediately. And I don't think me 10 years ago would have done that, because I wasn't kind of a values led, and I think that's a really kind of critical thing to be doing, especially if you're responsible for other people's money.
Sean really laid it down. I mean, from the bottlenecks from acquisition into the values needing to align with the people, all the way on the other end of capital, really laid out why this strategy would work. And I hear this a lot in single family, of putting together things that grow over time. Not as much as the equity in this particular thing, but it's the equity of the whole thing put together where the true value is. And to do this, you've got to build the right relationships. But number one, those relationships have to be based off of values that align across the board. And when something pops up, that value is not being met, you've got to make a change. Things like this inside of a business grow like cancer. Is just so bad when you don't make a change. If you want to stay in something because you don't have the time to fix it, that's probably somewhere where you need to make a change.